Well, it's another turning point for Trump's trade war, with the US set to impose 35% tariffs on imports from Canada next month and blanket tariffs on most other trade partners somewhere between 15 and 20%. Now, although Australia is yet to receive an official letter on tariffs, it will be impacted, but markets don't seem to be reacting much. In fact, markets are at record highs, volatility remains low. Well, for more on this and other catalysts impacting markets, I'm joined by Kerry Craig, Global Market Strategist at JP Morgan. Kerry, pleasure to have you on the program today. Thanks so much for joining us. Look, as I mentioned, a lot of factors, it's not just trade wars, but a lot of factors are playing into markets right now. Yet markets have been rallying to record highs, and this is really a global phenomenon. Is this warranted?
Well, I think it's the fact, and good afternoon, Ingrid, it's the fact that the markets are, trying to figure out what their path forward is for trade policy out of the US. We've been down this road before. We get a lot of announcements made through social media, the extension to the time frame of when they'll apply, and then eventually some dialing back of that rhetoric. So I think the market's looking back at the experience since April and suggesting that these numbers that we're hearing about in the last few days won't actually be what's applied overall. And it's choosing to look at the fact that, the economy in the US and broadly around the world is avoiding recession and still expanding, that you have central banks that continue to ease policy, which is loosening financial conditions and providing liquidity, which we're seeing go into the market. And again, looking forward to not just 2025, but to 2026, where they see corporate earnings continuing to grow. And so that all is catalyst for moving the market higher, or at least nothing that would prevent it from falling in this environment.
Yeah, I mean, is it ultimately the TACO, the Trump always chickens out idea that perhaps August 1st, although it's been put as a hard deadline, it won't actually play out that way?
Yeah, I think it's more of a case of thinking around how much of the tariff announcements that we're hearing, and those numbers are very large, are actually there to elicit a negotiation position relative to something that may actually be applied in the end. And I think in many cases, when we look around the world, a lot of countries and regions are actually in the midst of getting that agreement or framework in place, as we have with China, or looking at towards Japan or even the European Union. And so these numbers may be there to kind of try and speed up that process so they reach those framework agreements a little bit quicker. And I think it will again come back down to some of the sector tariff levels we're hearing about when it comes to things like copper and maybe pharmaceuticals. And then again, the carve-outs that are put in place for those, because it's never just the headline numbers. The detail does matter a lot for the actual impact on economies and companies when the dust settles.
Yeah, and this kind of brings you to the question of asset allocation, because, it's interesting. There's been a real lack of volatility in equity markets, which is surprising. I mean, I know April obviously brought that peak in volatility, but since then that volatility has really come off. Does this change sort of asset allocation going forward? Does it shift the strategy?
Not too much. I think coming into the year, everyone was aware of the concentration risk in the US market. There was a lot of money going into a small number of companies that were doing very well. You had the US as a share of the global equity market becoming very large. And the theme was really about broader international diversification within equities. And that has played out correctly if we look at the performance of, say, emerging markets or Europe. They've done very well this year. And I think that that's one of the reasons you're not seeing as much volatility, that investors are looking around the world for those opportunities, not solely focused in the US, and some of that positioning is starting to come through. Now, I would argue that there is still pockets of the US market that we do like around some of the mega cap and tech names, but I think it's that broader diversification which is actually meaning that we're not seeing that huge pickup in volatility on some of these quite fast-moving headlines.
And I guess, is it about playing a long game as well? Are you looking long-term? A lot of the tariff implications are long-term anyway.
Yeah, they're not too different to what the market has been expecting. So we had that big jump in expectations around the April 2nd announcement. The estimates were like the implied effective tariff on goods going into the US would be like 30%. Based on what we know today, our estimate is that it's 15%, so meaningfully higher than where it was at the start of the year. But none of the numbers we've heard about in the last few days would push us back to where it was in terms of that April 2nd announcement. And again, I think the market has a little bit better understanding about where the tariffs may level out. Higher from where we think they are today, but not as high as we had feared back in April. And again, that might be feeding into some of the, yes, it's uncertain, we're not sure about deadlines and what the final numbers may be, but it might not be as bad as feared. And I think that's probably good enough for the markets right now.
I guess the other big thing we're watching this week is the RBA, and it was a surprise to most that we didn't see a rate cut from the RBA. And it's surprising in itself that the RBA sort of Well, I mean, usually they like to prepare the market a little bit. I mean, the market was blatantly pricing in a cut. They knew that. Are you surprised by what happened with the RBA this week?
Yeah, I was surprised. I mean, I was thinking they would cut, looking at the economic data, looking at the rhetoric we'd had from committee members in their speeches, looking at what we heard at their last meeting. This very much did send a bit of a mixed signal when we saw the RBA step back and really set the case up for being more dovish, at least, and thinking about bringing forward the rate cuts. I think what we've got now is an RBA that is probably less focused on the downside to growth that would have stimulated that earlier need for rate cuts, and thinking about some of the fading of those big global economic consequences that are out there, and that feels less pressured to cut rates in this environment. They're also pushing back on the market in terms of focusing on the monthly inflation numbers we're getting, arguing that they don't contain enough information around the true level of inflation in the economy, preferring to focus on that quarterly number as the official number for inflation, and maybe that is not quite too far from their current forecasts, which would really need them to cut rates earlier. So I think they do have that capacity to surprise. I think they're still moving downward in the trajectory of rates, but that pace of rate cuts is probably going to go back to that quarterly pace in line with their statement of monetary policy and their forecast for growth and inflation. I
mean, the RBA itself has said that inflation number is extremely volatile, particularly the monthly number. I guess is August looking like a definite cut? And if so, why wait?
Well, we think they'll cut in August. That gives them time to get that quarterly inflation print, to see how the perhaps trade narrative starts to play through a little bit if we do reach that first August deadline, and think about some of the consequences of that. They're also focusing on the labour market in Australia. They feel it's a little bit too tight still, and so there could be that fear of wage pressure, which leads to inflation pressure in the economy. And so they'll get another labour market report next week, and maybe get some more information about the general easing in conditions that we're seeing in the labour market, and that may sway them enough to think about cutting rates. That decision when they released those voting numbers was fairly close. So I do think that there is a prospect for seeing another rate cut come through in August on the back of the two we've had already.
And in terms of market action after that, I mean, how are you expecting the market to play out in an environment where we're seeing rates be cut going forward?
Well, I think it's making the fixed income market a little bit more interesting in terms of we've seen quite a lot of a lack of volatility on the fixed income side as much as we've seen on the equity side. And that's always been a challenging place for investors who are looking to balance out that equity risk in their portfolio. So a little bit more stability in the bond yields, those rate cuts coming down, may pique a little bit more interest in investing in the fixed income market in this environment. And I think overall, as we see those rates come down, again, it should help the equity market as well. But a lot of this will have been reflected already in terms of the price. And so I wouldn't see it being a big catalyst for an upside, but again, not a reason to see the market pull back.
All right, lots to watch, of course, as always, Kerry. Really appreciate your insights. Thanks so much for joining us.
Thank you.